In this ecosystem, there are two ways that that investors make their money at the end of the day is with an IPO or with M&A. Volatility in those markets has led to some increased uncertainty and some additional caution. But even more than the price level, it's the dearth of IPO activity. We've just seen very few companies be able to go public. And there's a combination of factors there.
Welcome to Business Ninjas, brought to you by WriteForMe, where you'll hear from business leaders who are out there growing their business and slaying it every day. Learn from the masters. Let's get started.
Hi, and welcome to another episode of Business Ninjas. I'm here today with Isaac Salem, Vice President at Teknos Associates. Isaac, how are you today?
I'm doing well, Andrew. Thanks so much for having me.
My pleasure. I appreciate you spending some time with us on Business Ninjas. Please tell us a bit about yourself and about Teknos Associates.
Absolutely. So I started my career at Franklin Templeton Investments as a fixed income investor. We had a very academic approach to finding investment opportunities and currencies and bonds. And that's really where I learned how to do corporate credit. From there, I transitioned to graduate school. I got both an MA in international economics and an MBA. And I spent a couple of years at the World Bank doing evaluation work for them. Again, a very academic approach to trying to answer difficult questions with data.
Okay. And what brought you to Teknos Associates?
Yeah, after that, I was looking to move back to the Bay Area and also transition from the sort of large institutional world into a more entrepreneurial, faster paced, starting to really work with startups, still using the same finance tools that I'd acquired, just changing the focus from sort of macroeconomics to individual companies.
And what sort of services does Teknos Associates provide?
So Teknos Associates is a full service valuation consulting firm. Let's start with what a valuation consultant is. So the closest analogy that people have experience with personally is when you buy a home. The bank will send someone over to your home to try to get a sense for what that illiquid asset is worth. We do the same thing, but for companies, mostly for startups in the tech and biotech space.
I assume these are companies that are looking to be acquired or merge or grow in scale.
We do a lot. There are a lot of different reasons why a company would want a valuation. Most of the time, it's not that sort of strategic consulting. Instead, it's for financial reporting or tax reporting. So anytime you have an asset that's changing hands without a clear price being paid, you need to know the value of that asset to figure out what the tax basis is, or to reflect that asset in your financial statements at
And
value.
I'm sure there's some insurance implications as well in terms of what you're covering and all things like that.
Insurance, to go back to the mortgage example, asset-backed loans are another reason why you might want a valuation of a illiquid asset.
Got you. And what verticals are you servicing? I mean, you say startups, is that the territory you guys live in exclusively or?
Not exclusively, but primarily. Teknos Associates is based in the Bay Area. We were spun out of Page Mill Partners back in 2008, which is an investment bank that really focuses on the startup ecosystem. Our clients are mostly VC-backed, rapidly growing private companies, primarily in tech and biotech. But over the years, we have expanded to more traditional industries. We've certainly expanded beyond the Bay Area. We now have a presence in Boston and Texas. We tend not to say no, but the focus is definitely in the sort of VC world.
Is there a size of business that you work best with?
Really anything from founder startup all the way through an exit event. I'd say the sweet spot is acquiring new companies or bringing in new clients when they're about a year ahead of getting ready for a financial audit. So In the valuation space, there are companies that try to automate as much as possible and charge very little. And then there are very large, big four consulting, big four accounting firms that charge a lot and really depend on brand. And we sort of sit in the middle where we are providing a professional service that's much more art than science. It's much more about the expertise of our consultants. You develop a relationship. It's not an assembly line. It's not being outsourced. And so we tend to establish that relationship with new clients between Series A and Series B, and work with that client all the way through an IPO or an acquisition, that sort of thing.
Well, I assume that relationship is critical because we're talking about a very high level of disclosure if you're going to get it right. I mean, the books have to be wide open, not a little bit. This isn't, dipping your toes into their financial scenario. This is forensic level sort of accounting.
That's correct. Yeah. And I mean, one of my favorite parts of the job is really getting to know these companies, both the good and the bad. It can be really interesting. You definitely want that level of trust with your clients. There certainly are occasions where we're valuing an asset for an investor instead of a company. And the information rights, the information flow can definitely be a challenge in some instances. But at the end of the day, the question is, based on the information provided, what would a willing buyer and a willing seller transact at? And so if you're working with the company, you do need access to quite a bit of information about financials, cap table, financing history, and plans for the future.
What are the most common problems you're solving for your clients?
So primarily it's about financial reporting and tax. Um, but we're trying to get out ahead of future issues. So the most common valuation that we prepare is something called a 409A valuation, which is for stock options. So private companies want to conserve cash, they want to align incentives, and so they want to issue options to their employees. In order to issue options, you need to know what the fair market value of the underlying common stock is. And so we are helping the company come up with a valuation that is defensible, that will stand up to any scrutiny that comes from the IRS or accountants or the SEC, but that still allows them to grant options at the most attractive price that they can to their employees so that they can attract and retain the best talent.
Excellent. So it's a multi-pronged attack. And, in one way, you're proving value to someone who might invest, but you're also proving value to somebody who might want to be an employee down the road.
Exactly. Exactly. We're helping the company communicate with its shareholders and its employees the value proposition, both where they are today and where they may be in the future if things go right.
Gotcha. What differentiates Teknos Associates? What makes you guys stand out among your competitors?
Teknos Associates is a professional services business. So at the end of the day, what differentiates us is the personnel, is the consultants. We have a lot of experience across a variety of industries. We've seen a lot of different companies and a lot of different challenges. And so we bring that expertise and that experience to bear for our clients. I think one thing that really differentiates our model from where the industry is going is that we embrace that it's more art than science. We use judgment, rather than being beholden to any specific piece of data. With a lot of valuations, you'll see numbers that are just very precise, percentages that get down to 2 decimal points to try to estimate something like a discount for lack of marketability, when it's just false precision. There's no way to say that a 30% VLOM is exactly right and a 35% discount is wrong, much less 31.24%. At some point, I think a lot of financial professionals can lose the forest for the trees and get a little too comfortable, really believing that the numbers they're looking at are the truth.
One of my favorite quotes, 72.3% of all statistics are made up on the spot. if you're getting down to hundredths and thousands with what we're talking about, I start to question what we're talking about.
Agreed. Agreed. And inherently, there's just a lot of uncertainty when you're talking about rapidly growing companies. Most of our clients are trying to do something new, something that hasn't happened before. There isn't a direct comparison to some publicly traded company where you can observe the multiple of revenue or EBITDA that, this other company is trading at and just apply that one to one. It really does take judgment.
Yeah, it's hard to quantify the value of a disruptive technology because you certainly don't know the level at which it's about to ripple the pool and how it's going to be received. Let's switch gears for a minute. The pandemic was an awful time for a lot of industries, but I'm under the assumption that it was one of the busiest times in M&A. Were you guys slammed during COVID? Was it a really busy time for you?
Say I divide the period into two, and in 2020 and 2021, that's absolutely the case. We were really busy. the After the first 6 week shock, the market really took off. I mean, there was a lot of liquidity in the system for corporates as well as for individuals, and we did see a lot of M&A activity. We did a lot of purchase price allocations, a lot of fairness opinions, work that supports that sort of M&A activity, in addition to the more traditional just companies being able to raise financings and therefore needing a new valuation. Right around the turn of 2021 to 2022, though, the environment really changed, and we went from a high liquidity environment to a low liquidity environment and a much more difficult fundraising environment for private companies. We still see plenty of deals getting done, at least if you're looking at the overall volume of fundraising activity, of VC activity. But the number of deals has continued to shrink year over year over year. So we're really seeing sort of a bifurcation of the market where if you're a repeat founder, if you're starting an AI startup, the terms are out there and you can really set whatever price you kind of want for your fundraising round. However, if you're a first time entrepreneur, if you're in biotech, it's really the VC ecosystem has become much less patient, and is a little bit more risk averse than pre 2021 era.
In your estimation, is that in response to the volatility of the stock market and other investments that are not necessarily as linear as they had been for quite some time?
I think there are a number of causes. And when you talk about the stock market, right, you're talking about exits. In this ecosystem, there are two ways that that investors make their money at the end of the day is with an IPO or with M&A. And I think you're right that volatility in those markets has led to some increased uncertainty and some additional caution. But even more than the price level, it's the dearth of IPO activity. We've just seen very few companies be able to go public. And there's a combination of factors there. I think the volatility that you described is absolutely one of them. We came into 2025, there was a fair amount of optimism, even in a place like Silicon Valley, that the new administration would come in and cut taxes and reduce regulation, and that markets were going to do really well, and that the IPO window would be wide open. And instead, we've seen a return to a lot of volatility, and nobody's going public right now. There's no appetite. It's a very costly transaction to undergo, and there's no guarantee of any sort of valuation, any sort of pricing level. And so, even more than just the question of at what price due to volatile markets, it's how many years are we going to be involved in this company until we're able to find a suitable exit.
Again, this is the most tenuous economy in my lifetime. I mean, everybody's waiting for the other shoe to drop, but there's shoes being thrown every day in various directions. I don't know anybody who really knows what 6 months from now looks like. It looks like people are putting their money in real estate more than anything else because at least there's some sense of linearity and security there. Is that is that true in your space?
I think the point about uncertainty is a really good one. And the financial press tends to boil down very complicated, right? What causes the market, the S&P 500? Let's just take one relatively simple market. What causes changes in the S&P 500 in any one day? There's a plethora of factors that drive market movements. That's why markets are powerful, is that they're able to incorporate a wide variety of information. And so I think the price movement of public equity markets tends to be seen as a source of uncertainty. But for venture capital, for investments that are intended to be held for 5 to 7 years, over the life of a fund, what matters much more is the macroeconomy, is the health of an industry, and is technology. It seems crazy to say, but the impact of AI has sort of been forced to the back row in terms of concerns relative to just this huge level of policy uncertainty that we're seeing. But AI, 2, 3 years from now, what that's going to mean is just it's very hard to say. Basically, every client we have is incorporating AI in some way, but how that's going to evolve, is it just being slightly more productive? Is it simply about investing today and being more profitable tomorrow? Is it a slightly better user interface for your software, where instead of a chat bot, or a search on your website, you're dealing with AI, that's making recommendations to you? Or it could be something, completely transformative. I think one industry that I've really seen change is educational software. And frankly, not for the better. We work with a number of companies that built real, large, profitable businesses around supporting education. And overnight, essentially, those businesses fell out of favor and started losing market share because who needs a warehouse of study materials if you have Chat GPT, right? The cost of creating a new outline is essentially zero. And so even if the quality isn't there, the market isn't there yet, and it's getting better every day. The market's assuming it's going to get better. And I've just had a number of clients that even when they built very successful businesses, um, because of the landscape, because of the change in their industry, it's really gone away quite quickly.
Well, hey, AI is still just a tool, right? It has to be implemented and stewarded by people with talent and skill. I mean, in your space, I'm sure there are AI tools to look at a company's tax returns and bank statements and make some broad, mathematically correct assessments of that business. But that doesn't negate somebody with a history like you who has a very different, sense of what you're looking at and who you're looking at, because there's still people involved in this equation, which the algorithms are not necessarily accounting for at that level, right?
I think that's right. I mean, you touched on a couple of things there. I don't want to come across as, as a Luddite. I definitely, we use a lot of data, we use a lot of technology. But the key is the judgment at the end of the day. There aren't these one-to-one comparisons. And you need to make sure that your analysis is informed by the data, that the patterns that technology can help uncover is, that you're exploring those, you're trying to understand the connections that are being made. Um, but oftentimes, you're not going to allow that analysis to substitute for your own judgment and the judgment of your client. If we're working with the CFO of a startup, we're going to get to know the business, we're going to do the due diligence. But if our analysis is telling us something that the CFO, disagrees with, most of the time we're making an assumption that's incorrect. Most of the time the CFO understands the business better than we ever will. and we're just missing something. We're making an assumption that is appropriate in some cases, but not this one.
Gotcha. Well, hey, AI and assumptions are not not good bedfellows. Let's put it that way.
There you go.
All right. Look down the road a year from now. What are some things you'd like to be celebrating personally and professionally?
I think 1 year forward, I'm hoping for a little bit less volatility, a little bit more consistent deal flow. It's so hard to find that Goldilocks zone where you're not way too busy, which was the first 3 months of this year. You're not a little bit concerned about the lack of deals coming in. I think having a steadier state would be really nice. I think one thing that affects me personally, professionally, but is a much bigger issue is just an improved fundraising environment, especially for biotech. I've seen a lot of companies that are just have really promising science go out of business over the course of the last 3 years. The fundraising environment is really challenging. And unlike for a software company where they can tighten their belts, focus on profitability and runway instead of revenue and ARR growth, a biotech company, they can't wait. They have to spend money to develop these assets. If all they do is wait, all that's happening is the life of their exclusivity is ticking away, right? The IP is getting less valuable all the time. And so they have to try to fundraise. Frankly, the cost of raising subsequent rounds to fund phase 2 and phase 3 clinical trials is just getting really, really high. And it's going to mean less innovation going forward.
Those are sad words I'm hearing from you because you're a pretty good weather vane for that kind of thing. And if people don't want to invest in the furtherance of healthcare and revolutions in diagnostics and cures, that's a very expensive problem down the road for all of mankind, not just investors.
I completely agree. And, there's this double whammy in the industry of grant funding also being reduced at the same time that it's harder and harder to get market funding. And so, yeah, I am definitely nervous that we're creating a problem that is just going to grow over time.
Any optimism you can drop on us here?
Absolutely. So I do think that, technological innovation continues to just accelerate, if anything. In terms of optimism and excitement, I'm working with a lot of companies that are doing really cool things, that are taking big shots. And, living in San Francisco, one example that you see is autonomous driving. I'm really optimistic that by the time my 6-year-old is ready to be getting his license, he's not going to have to be driving anywhere. As a parent, that would be a game changer. You know, Another industry that I think is really misunderstood, that I think it has the potential to do a lot of good, is cryptocurrencies. Teknos Associates does a lot of work in the digital asset space. I personally am a little bit less involved, but I have colleagues who that's all they do is work with companies that launch crypto assets. And I think a lot of the attention focuses on speculation. What's the price of Bitcoin today? Or just coming up with these coins that are just the digital equivalent of like a commemorative coin that's being sold on an infomercial at 3 o'clock in the morning. There's no value there. But things that get a lot less attention are the real world benefits of cryptocurrencies. I think the clearest one that is definitely, impacting the world today is the store of value, the ease of finding a store of value in economies like Argentina and Venezuela, places where you can't necessarily even find a safety deposit box to store the dollars that you're able to get or the gold that you're able to get. And that's a real challenge for everyone in the society. It leads to spending and shortages and tons of inflation. And so the introduction of an easily obtainable store of value has the potential to really transform savings and therefore transform the economies that have historically really struggled with places to find that stability. And that's a primary use case, dating back nearly a decade now, that market participants have been aware of. I think a second really important use case for crypto assets is payments. Payments isn't the sexiest industry, but it is massive. If you think about the transaction costs of even just, using your Visa for a transaction, locally, it's a material percentage. And there's a reason that Visa has these crazy EBITDA margins, right? I mean, these payment companies make 50, 60% margins. And I don't think that's sustainable when we now live in a world where in 1 second, for 1 cent, you can move a stable coin anywhere in the world. I think that transformation, we're seeing it in remittances in particular, because that's just a real pain point. But I think traditional transactions, either the incumbents are going to have to bring their prices down, or there's going to be real disruption. And I think it will be to the benefit of the economy overall to have less costly transactions, to have less friction in the system. And then I think the third use case, sorry to go on, as you can see, there is some excitement when it comes to crypto, just not, speculating on crypto. It's really about using blockchain technology to solve real world problems. And this third use case is that blockchain technology. It is decentralizing infrastructure. We've got a client named Helium, for example, that today you can get a cell phone from them and a cell phone plan where you make mobile calls and you never touch a cell phone tower. You're only relying on hotspots that other individuals have in their homes, and you're paying them directly through the blockchain, literally decentralized infrastructure, and a really cool lower cost cell phone provider. Today it doesn't work very well if you're going to Big Sur. But if you're in San Francisco, I've tried it compared to Verizon, and the service is just as good.
Well, hey, this is a subject for an entirely other podcast, but I'm of the opinion that the messaging needs to change around the word blockchain. The average person, you say blockchain and they immediately think crypto and Bitcoin. The reality is we are all benefiting from blockchain technology and security every single day, every credit card transaction. And there needs to be a separation of the subject matter because the average person needs to know and have more confidence in the system than they do, and not just immediately think of Bitcoin when you say the word blockchain. But again, that's a whole other podcast right there. Well, please tell us, what's your URL? Where can people find Teknos Associates, and what social media channels are you using as well?
So people can find us online at Teknos, which is Teknos associates.com. We put out a fair amount on LinkedIn. So those are really the two best channels to find us.
Excellent. Isaac Salem, thank you for spending some time with us on Business Ninjas. All the best to you and yours, and continued success at Teknos Associates.
Andrew, thank you so much. It's been really good talking to you.
My pleasure. Be well.
Appreciate it.